Mainstream financial analysis often frames the ongoing US-Iran conflict as a chaotic, unforeseen, and massive drain on American taxpayer capital. Hello everyone, and welcome to Stewardship Finance Academy. Macro financial data reveals a deliberate mechanism designed to manage global energy prices. This strategy is driven by a domestic crisis, the $39 trillion US sovereign debt load. To maintain a debt of this scale, the system requires a way to manufacture continuous global demand for the US dollar. Inducing this demand forces global capital into US Treasury bonds, which compresses yields and saves the government hundreds of billions in interest payments. This cycle is designed to facilitate capital flight, creating a pathway for institutional players to acquire distressed global assets at a discount. Understanding this mechanism requires looking at the baseline economics of the energy market, specifically the stark asymmetry in oil extraction costs. American shale production involves complex technological extraction from deep underground. Because of these requirements, it costs the United States between $50 and $60 to produce a single barrel. By contrast, Middle Eastern oil is fundamentally more accessible. In nations like Saudi Arabia or the UAE, the total cost to extract and transport a barrel is roughly $12. This chart compares the production realities. The $60 US baseline towers over the $12 Middle East cost structure. This creates an unviable position. If global prices drop to $40, the Middle East still profits heavily, while US producers bleed cash. To prevent this, the US historically flooded the market to act as a loss leader. Selling at a loss was the price of enforcing the petrodollar system, and ensuring global energy was priced in US currency. That strategy faced a direct threat when Middle Eastern producers began accepting the Chinese yuan and euro for oil transactions. The financial bleeding became unsustainable last year, leading to mass layoffs at major American firms like Chevron and ExxonMobil. Because the US could not survive by cutting prices, it was forced to engineer a scenario where global oil prices had to rise. When the military tension with Iran escalated, global oil prices immediately surged toward $100 a barrel. For the US, this shift is transformative. At $100, shale production flips from a loss to an estimated $60 billion windfall. Iran simultaneously capitalized on the disruption by utilizing their control over a primary geographical choke point. Iran effectively transformed the Strait of Hormuz into a global rent collection booth. This map shows the economic leverage. With oil pushed to $100, Iran demands a $2 million transit fee. Ships refusing the fee are forced into a massive 10,000-kilometer detour around the Cape of Good Hope. Between extra fuel costs and spiking insurance premiums, the detour is significantly more expensive than the $2 million toll. This leverage provides Iran with an estimated $100 billion in annual revenue from transit fees alone. Despite ongoing sanctions, the doubling of oil prices allowed Iran to earn 37% more revenue than they were making in peacetime. In this system, military friction acts as a toggle for global energy prices. Both nations are generating record revenue from the same crisis. This brings us back to the primary driver, the US sovereign debt. Because long-term borrowing risks aggressive currency depreciation, 87% of all recent US borrowing is strictly short-term. The specific instrument dictating global borrowing costs is the 2-year US Treasury yield. This tracks the 2-year yield. The US borrowed massive sums at 5% during 3 spikes. When the early 2023 debt matured 2 years later, they launched a 2025 global tariff war, forcing capital into treasuries and driving yields down to 3.4%. Lowering that rate from 5% to 3.4% saved the government approximately $300 billion in debt service. We are seeing this exact cycle repeating right now. The high-interest loans taken out in mid-2024 are maturing in mid-2026. The Federal Reserve cannot lower rates further unless a new global crisis forces yields down again. To survive the refinancing schedule, the system must manufacture a crisis, perfectly timed to force the globe to hand the US low-interest loans. During an energy shock, nations initially sell off US bonds to raise the cash needed to buy inflated oil. But if oil remains at $100, factories lose power and the global economy enters a deep recession. This strategy targets Asia's manufacturing base, which is almost entirely dependent on energy imported through the Middle East. When industry completely stalls out and global recession hits, terrified investors liquidate all their local assets in a panic. This chart tracks the resulting capital flow. An energy blockade leads to recession and asset liquidation, which funnels capital directly back into US Treasury bonds. This follows the 2022 template, where the energy disruption in Europe caused the euro to drop 22% as capital fled to the US. As Asian economies face similar pressure, terrified citizens move their capital to the US dollar, further increasing its value. US institutional capital can then take that strengthened currency back into foreign markets to acquire manufacturing and tech infrastructure at a fraction of its value. This cycle allows the four pillars of American capital, energy, defense, tech, and financials, to take turns generating record profits. Because of these entrenched interests, global peace is highly unprofitable, and severe inflation is a structural feature of this decade. For the retail investor, cash is depreciating rapidly. Blindly buying the dip during orchestrated chaos only provides exit liquidity for institutions. The smartest money is not simply gambling on recovery. They are sitting on cash, waiting for the macroeconomic harvest. To survive this transfer, you need a system. Click the link in the description to enroll in our free stock investment masterclass today. It is now time to stop acting as prey and start thinking like an institutional investor. Thank you for watching.